Good afternoon. You're listening to Gambling with an Edge. Now here are your hosts, Bob Dancer and Richard Munchkin.
Good afternoon. Welcome to Gambling with an Edge. I'm Bob Dancer.
And I'm Richard Munchkin.
Our guest is Tax Authority Russel Fox. We have lots of tax questions from you, our listeners, and we're going to let Russ give it his best shot. Russel Fox, welcome back to Gambling with an Edge.
It's great to be back.
Let's say I wanted to take a trip to the Northeast and sign up for sports books in every state that allows sports betting. In each state, I estimate I'll have gross winnings around $50,000, although my net winnings would be closer to $5,000. Would I run into any state-related tax issues if I pursued this?
Well, you'd likely have a state tax filing in many of those states. For example, New York has a state income tax, and if you earn income in New York, you owe that. You'd also be able to take a tax credit on your home state's state income tax return. A couple states do not tax non-residents' gambling income in the Northeast. Those are Connecticut and New Jersey. So those states, if you're non-resident, you can earn income and there's no additional tax filing requirements. But there are definitely state tax implications.
All right. Next question.
Actually,
I play daily fantasy. Oops. Go ahead, Richard.
Yeah. Do you know if those are reported by, for example, in New York, if you win a $5,000 sports bet, does that get you a W-2G or any other kind of tax form?
Well, W-2G for sports betting is issued only if you have winnings of $600 or more, and the wager versus payout has to be 300 times. So it's very rare to have sports betting W-2Gs. Most of the time it's like prop bets. Like if you take the Jacksonville Jaguars to win the NFL Super Bowl and they happen to win it, that's probably going to be at odds of 300 to 1 or more.
Right.
And you would have a W-2G issued. However, some states in their sports betting rules and their online gambling rules require the sites to report it to the state's tax agency. So just because there's no formal W-2G issued doesn't mean that there isn't reporting.
Aha. So some of our listeners who weren't thinking about this may someday get a letter from the state of New York saying, hey, you owe us money.
Definitely possible.
All right. Definitely possible time for the next question. I play daily fantasy sports as a serious recreational player. Each week in the NFL season, me and 4 friends each enter one lineup into DraftKings $20 Millie Maker contest. We agree to split our winnings equally amongst the 5 of us. That is, we'll all receive a 20% piece of one another. It hasn't happened yet, but surely we will hit the big score one of these weeks. What is the best way to handle tax implications from this inevitable, I think those are supposed to be sarcastic, inevitable $1 million win split 5 ways? I would assume it's similar to how poker players handle taxes with regards to staking.
And indeed, it is exactly the same as poker. The winner will need to issue Form 1099 miscellaneouses to each of his friends. I do wonder a bit about inevitability here, though.
A strong bit. All right. Next question. Next time you have Russ Fox on, I'm hoping you ask him this question. A hypothetical avid recreational horse player bets on a minimum weekly basis, at times near daily basis, and grinds out a small annual profit. Most of the tickets are not signers, meeting the 300 to 1 and $600 and up threshold. But the end of the year shows a profit of $1,000 to $10,000 from horse wagering. There will be a signer ticket or two in there. And also possibly unreported winnings from group tickets with friends. What is the standard for reporting this income correctly? Is each day its own session? Or each track? Or each meet? From my personal experience, several tax preparers have looked at W-2Gs with puzzlement when I presented them. Would love to have more clarity as I look to expand my play. All right, there's a lot there. Go for it.
Well, as Gertrude Stein said, gambling is gambling is gambling to the IRS. There's unfortunately no case law on the specifics of session reporting vis-a-vis each bet or on exactly what can be netted for horse bettors. But it's pretty clear some items can be. For example, let's say there's a daily double in races 3 and 4. You bet horse 1 in race 3, and you link that to multiple horses in race 4. That's clearly part of one grouping of bets. And if you win, say, $25,000 on the winning pair, but the cost of your bets are $4,500, I am certain you could net that into one win of $20,500, even though the W2G would say $25,000. It's also probable but not certain that you could combine a day's activities into one session, as it would meet in our minds the normal meaning of a session, because we would describe a session at a racetrack, a day at the races. The ability to use session accounting for gambling was upheld in a court case at the Court of Appeals for the District of Columbia called Park v. Commissioner, written by a judge named Kavanaugh in 2013. And yes, it's the one you're thinking of.
Oh, I wasn't thinking of any judge named Kavanaugh. So now I'm confused.
So does horse racing have the same restrictions about being a professional gambler to write your losses off against your wins?
The rules for professional gamblers don't matter what kind of gambling you're in, whether it's poker, sports betting, horse racing. Those rules are uniform based on gambling, not the specifics kind of gambling.
That's what Gertrude Stein told me, but I just wanted to check.
Next question. See if we can get Gertrude Stein into this one too. Say, if I bet into my DraftKings account for myself and another individual, and the net profit for the year is $50,000. $20,000 of that profit is for an individual bet I made for, and only $30,000 is my actual profit. It seems. When reporting, I wouldn't have to report incomes on the individual that is not me, would I? Even though the DraftKings account is in my name? Would I be responsible only for my own earnings?
Well, a fundamental principle of U.S. taxation is everyone pays taxes on their income, not anybody else's. The issue arises, though, because DraftKings would send this person a 1099 for $50,000. That individual would need to issue another 1099 to his friend so that the income would be appropriately split. And probably, if he's not a professional gambler, attach a statement to his return so there's at least a chance the IRS looks at it correctly.
Okay. Next question. What is an FBAR, and do I need to file an FBAR for offshore sports betting accounts?
Well, FBAR stands for Foreign Bank Account Reporting and also includes securities. Like what we normally think of, if you're just looking at it, would be like a bank account in Switzerland, a brokerage account in Paris. Those would be foreign financial accounts. It's specifically Form 114 from FinCEN, the Financial Crimes Enforcement Network. You have to file this form if you have $10,000 aggregate in one or more foreign financial accounts anytime during the year. The FBAR is due concurrently with tax returns, so mid-April, but there's an automatic extension for 6 months, making its effective due date mid-October, this year, October 17th. In the United States, casinos are considered financial institutions by FinCEN and are subject to the Bank Secrecy Act. That's why currency transaction reports and suspicious activity reports are done by casinos. In the only case to reach a court of appeals to consider whether online gambling accounts are foreign financial accounts, The Ninth Circuit Court of Appeals ruled in 2016 in a case called United States v. Hom that poker stars and party poker accounts were not reportable. However, the U.S. Department of Justice argument that poker stars and party poker were casinos was made only during the appeal, and the U.S. explicitly, during the actual trial, disclaimed reliance on that theory, so the Court of Appeals ignored it. Unfortunately, the Bank Secrecy Act defines casinos as financial institutions, so it is nearly certain that had the Department of Justice made this argument in the initial trial or raised it in their briefing on appeals, that the U.S. would have won the case. Thus, offshore offshore sports betting accounts absolutely should be reported. And yes, so that means most of the people who gamble on sites like bookmaker.eu should be filing FBARs.
And does crypto have something to do with FBARs, or is that a separate thing you have to file?
Well, FinCEN ruled a couple of years ago that cryptocurrency itself is not reportable on the FBAR. However, cryptocurrency held in an exchange where that exchange also holds money, fiat currency, US dollars, euros, that account with the exchange is reportable. So some foreign cryptocurrency accounts are reportable, but a account at, say, Russ's crypto exchange based in Belize that never allows any fiat currency would not be reportable.
Uh-huh.
Got it.
I didn't know you had such an exchange, Russ, but okay, good. Learn
I
something.
wish I did. I'd have made a lot of money over the past few years.
Well, certainly if you got out at the right time, too. Okay. Next question. I recently bought an RV to go around the country playing blackjack and other AP related things in each state. Am I able to write off any expenses like my RV, food, gas, etc.?
Well, the first question, and it's not specified by this individual, is whether he's an amateur or professional gambler. If he's an amateur gambler, he can't write any expenses off because amateur gamblers are not allowed to. If he's a professional gambler, business travel expenses are deductible, but there's a big caveat. There's a rule called the traveling salesperson rule. A traveling salesperson travels throughout the year, doesn't have a home, and travel expenses are defined in the Internal Revenue Code as being away from home. So a traveling salesperson can't deduct travel expenses because he's never away from his tax home because he doesn't have one. So if you don't have a home you return to, you cannot deduct travel expenses. So that's a huge caveat that people who have RVs need to be aware of. Now, if you travel, say, 10 months of the year and have a home or apartment someplace, then you have a home you would normally return to, and this rule would not apply to you. Second, there's no standard deduction for RVs. Unlike if you're driving a car or light truck, you can take the standard mileage deduction, just note your mileage times the standard mileage rate. However, that does not apply for RVs. You must use actual expenses, and you absolutely must have a mileage log. The specifics here pretty much demand you speak with a tax professional about your situation.
So you can
Okay.
still write it off. You just have to keep track of it as opposed to using mileage, standard mileage deduction.
Well, everyone's supposed to be keeping a mileage log to deduct mileage. But the caveat here is not only do you need to keep a mileage log, you need to keep your gasoline receipts, your oil change receipts, every expense you have. You also have to separate out, really, if you have multiple vehicles, you have to note on those receipts which one was for your car, which one was for your RV, because they're probably charged to the same credit card. There's a lot more work here.
Okay, next question. There's a couple of either words or grammatical help, so I'm not exactly sure what it says. I'm going to guess and read it the way I guess it's supposed to be. and we'll take it from there. Not sure if this is a tax or a lawyer question. It appears that if you cycle $200,000 through PayPal starting in 2000 to legal place it into states' online gambling or sports betting accounts, then PayPal reports it to the IRS, and PayPal calls all of these transactions sales. Is this true? It sounds like a nightmare.
Unfortunately, it is basically true, and it is nightmarish. I've already PayPal issues a form called the 1099-K. It's for third-party payment transactions. For my business, I get one for my credit cards because we process credit cards. And for that, it's pretty simple. I process, say, 300,000 of credit cards. My credit card processor sends me a 1099-K saying I processed 300,000. No big issue. Here, though, it's movement of money, and the IRS, of course, interprets this as that's all income, and it's not. It's movement of money. And I've already seen what's called a CP 2000 notice where the IRS disputes an item on a return for a sports bettor who had, let's just say, $500,000 of transactions when the actual gambling win was 75,000. And we've since responded. We're waiting for the IRS to actually read the response, which right now takes 4 to 6 months. But eventually, my client's going to be fine because he kept excellent records of all of his bets. But here, there's a big caveat if you're using PayPal or any similar service to move money back and forth. You need a log of those transactions and a gambling log because it's the only way you're going to be able to prove to the IRS that that wasn't income.
Okay. Another question. I have a question with regards to slot pools, which is when a group of people pool money together and agree to split the winnings. In this scenario, it's a group of 7 people. Usually one person, let's call him Bob, thank you very much, is designated to take the tax hit, no thank you very much, and they get lucky and let's say they hit $1 million jackpot.
Inevitably.
Inevitably, for sure. Now I'm glad it's Bob again. Let's say the casino takes out the tax and the total money left is $700,000, which will now be split among the 7 people. In theory, the first person, Bob, has already paid taxes for his portion. The other 6 people receive their $100,000 apiece. The question is, if the other 6 people are expected to report $100,000 as winning and then essentially pay tax on that, logically the taxes have already been paid, but in some areas the government does not think logically and they always have their hands out. So how should they do this?
Let's look at this from Bob's point of view, reporting on his tax return. He's going to note the W-2G for $1 million, and then he's going to subtract out the 1099s he's going to issue to everyone. So he's going to be left with, 1/6 of the $1 million, about 166,000 of income. Here, he's going to also note that there was withholding of 300,000. We'll ignore state withholding, and he's going to get a refund based on his income tax, presumably. He'll, we don't know his other income, but if there isn't any, he's going to owe, say, 30, 40,000 of tax, and he's had 300,000 withheld. He'll get a refund of $260,000 or so. Meanwhile, everybody else has 166,000, not 100,000, 166,000 of income. The withholding does not get split among the people. That withholding was only reported to Bob. So everybody else is going to owe tax on 166,000 of income. Period. Or, whatever 1/7 of $1 million, since I think I did 1/6, not 1/7. But everybody is going to have to file their own return. And yes, everybody's going to be paying tax. Overall, it will equal out if everyone's tax situation is the same, which is never the case. But withholding stays with the individual who had the money withheld.
Okay. Next question. If a W-2G is issued on a Native American casino such as Harrah's Rincon, currently called Harrah's Southern California, is this considered income earned in the state of California for non-residents of California who may or may not have California income of other types? Or is this considered income from another country?
This is another it depends situation. Each Native American casino has signed a compact with the state it is geographically in. However, Indian reservations are considered sovereign territories. If you, for example, violate traffic laws on an Indian reservation, there's special police Indian from that Indian reservation that will pull you over, not the normal state police. These compacts generally specify whether or not income earned at casinos is subject to state income tax. Most of the time, if nothing is specified, no state tax is owed because, again, they're sovereign territories. These compacts tend to last 20 to 30 years and are then renegotiated. Most states forgot about this when they did their initial negotiations, and most states have wised up on this and are now trying, when these compacts have come up for renegotiation, to specify that they want the earnings from non-residents, basically anyone, to be subject to state income tax and reported to the state government. I unfortunately do not know about Harrah's Southern California, whether or not they have a new compact or not, so I can't answer the specific question, but unfortunately, each compact has to be looked at separately.
So does that mean that before in the old compacts in some of these places, people who worked there as dealers or floormen didn't have to pay state tax?
Well, that's employment law. We're
Oh,
going
so
into
that's different than
multiple areas, but in some cases, first of all, you owe U.S. income tax on your worldwide income.
yeah,
So
yeah,
there is
but
no
state.
escaping U.S. income tax, whether you win a jackpot at Rincon or in Ruritania or wherever. Doesn't matter. State income tax, you owe state income tax on your worldwide income for your home state. We as Nevada residents are a little lucky because our state income tax rate is zero. So we don't have to deal with it. But a Californian is going to owe state income tax regardless. The last time I looked at this, for example, all of the Oklahoma casinos, and the only casinos in Oklahoma are Native American, none of them are reporting to the Oklahoma Department of Revenue. None, as far as
Wow.
gambling winnings. However, I know of at least one in Wisconsin, I know of two in California, etc. It depends.
All right, next question. Two players, Al, who files as a professional gambler, Bo has video poker and advantage slot skills, a full-time job, and a wife who can't handle gambling swings. Both players are putting in 20 hours a week gambling on a joint bankroll with an intent to win. They want to form a partnership. On months they win, Al gets 75% of the win and Bo gets 25%. On months they lose, Al bears the entire loss. How should they set this up so as not to run afoul of the IRS?
Well, partnerships have fairly wide discretion on how they distribute their income and losses. So, as long as the partnership agreement states basically what this individual has said, there shouldn't be issues with the IRS. And as long as the tax returns appropriately reflect it. However, I'm a tax professional, not an attorney, so I cannot give legal advice on the formation of the partnership.
So an attorney would be able to tell him whether it's better to have a corporation or an LLC or whatever. Is that what you're saying?
Partially. Generally, a partnership would probably be fine. That I can say because a partnership is informal. It's two individuals acting together for a joint purpose. The reason most people form business entities is liability protection, Most professional gamblers don't have that as an issue. So for the most part, it's hard for me to envision the need for a formal entity. There might be a reason. That's one reason to talk to an attorney. Second, you need a partnership agreement, and that's done by an attorney, not a tax professional.
Okay, a spur of the moment question just occurred to me. You've not heard it coming. I'm wondering if you can answer it off the top of your head or can refer me to a particular source. Last year, 2021, I played at Harris Cherokee in North Carolina. I hit some W2G jackpots of $5,000. They have an attractive Deuces Wild game there. I put that in my normal daily log that combine other winnings in play. Most of the rest was in Nevada, but there were some W2Gs from North Carolina. How do I find out if I have any North Carolina tax consequences for those jackpots?
Uh, Cherokee hasn't renegotiated their compact, and it is not reported to the state of North Carolina as of the end of last year. So for 2021, you almost certainly, unless you have nexus to North Carolina from something unrelated, like you have a rental property in North Carolina that you're renting out, okay, you you would not have a North Carolina filing requirement based on this gambling winnings. Other things could cause it, but not winnings on Cherokee as of today.
Good. As far as I'm concerned, that's the right answer. And I'm going to celebrate hearing the right answer by having some commercials right now. We'll be back to Russell Fox momentarily. The South Point has more than 10,000 games, returning at least 99%. This is more such games than anyone else has. In August, the promotion is free play with a kicker, and it's only for locals already receiving mailers. Instead of receiving your normal mailer amount 4 times, Tuesday through Thursday each week, this time you get your mailer once each week, Monday through Wednesday, and if you pick that up, you get the same size mailer Friday or Saturday of the same week. Pick up all free play offerings and you receive a double amount on Monday, August 29th. For example, if your normal offer is $50 a week, normally you'd end up with $200 a month. In August, if you make the 5 extra trips required, you'll end up with $500 a month.
If you're serious about card counting, the Blackjack Apprenticeship membership is a great way to learn, train, network, and get the resources you need to succeed. We've had quite a few guests on Gambling with an Edge who exclusively trained and got their start through Blackjack Apprenticeship. Check out their website at blackjackapprenticeship.com. They have member forums, training software, and guides to help you learn. So that's blackjackapprenticeship.com, and you will find a link in the show notes.
Videopoker.com is the best place to play lots of games. If you sign up for the gold membership, $8.95 a month or $79.95 a year, this allows you to get correction on most of the games. A version of that's been out for about a year is called Powerhouse Poker Plus. This plays the same as Powerhouse Poker, but it was created to take advantage of taller screens. Now, instead of one hand with an 8x multiplier and one with a 10x multiplier, you actually receive 18 different hands. This will have a low variance than the older version, but the same EV and the same strategy. All right, we are back talking with Russell Fox. If I have winnings at a casino that would generate a W2G, can I choose to not give them my social security number and have them withhold whatever rate they withhold for foreign citizens? I understand it might be a higher rate than my tax rate, but I feel it might be worth it to not have to worry about including it in my taxes.
Well, the correspondent, unfortunately, will have to include it in his taxes, period. He still gets the W-2G. Additionally, for the IRS, yes, he can refuse to give his social. Withholding would be at 24%. Some states, though, mandate it for the payout. Otherwise, the payout will not happen. So state law comes into play here. And one, this individual would need to paper file his personal tax return. And two, his chance of being audited goes way up. The IRS doesn't like this.
Yeah, I don't think they'll pay you if you don't give them a social security number.
Technically, you can refuse, and the withholding would just be at 24%. However, state law could mandate it. Federal law does not, state law might.
Well, I think Russ gave the wrong answer here, and let me explain. You do not have to accept the W2G. Let's say you got a $4,000 jackpot on your machine. To avoid doing this, all you have to do is leave the casino immediately as soon as a jackpot appears on your machine. They will not chase you. Of course, you do not get the $4,000 nor any credits accumulated on the machine before you hit the jackpot. But if you wanted to avoid a W2G, this is a way to do it.
That is another way, but I'm pretty sure the way this was written, this individual wanted his cake and eating it too.
Well, I'm pretty sure you're correct, but APs like technicalities, so I feel proud of myself. Let's go on. You've had a history of figuring out how much the tax bite is for each of the final 9 players in the main event at the World Series of Poker. Have you had a chance to do that this year?
Absolutely. It's up on my tax blog, taxabletalk.com. It came out a day or two after the main event ended.
Can do you have the data with you to mention it,
Let
or
me. I didn't, but let me just pull it up. Yep. Well, the winner, Epson Jorstad of Norway, resides in the United Kingdom, so he won $10 million and he gets to keep it all because he's a UK resident. Adrian Attenborough, who came in second, won $6 million, lives here in Nevada. I estimate that he will be able to keep 3.6 million. John Eames, who came in fourth, lives in the UK. He won 3 million and gets to keep it all. The UK does not tax gambling, and the US-UK tax treaty specifies that gambling winnings of a UK resident, there's no withholding. Michael Dweck finished third for 4 million, but he finished fourth as far as after tax. He lives in Florida, and I estimate he'll receive a little over 2.4 million. And I did this for all 10 final table finishers, and living in a country which doesn't tax gambling is a very good thing. We'll leave it at that.
How easy is it to get the UK citizenship?
Not
residency
easy.
is all you need?
You need residency, and it was easy if you were an EU resident. For example, Mr. Jorstad lives in Norway. When the UK was part of the European Union, he just moved. Not a problem. Saying John Eames is a UK, he was born in the UK, so obviously a non-issue for him. And the 8th place finisher, Philip Suki, who is French, moved to the UK for the same reason, to avoid French taxes on gambling, which are very high.
So for an American to get UK residency is tough? Or
Very tough.
yeah.
Well, you first of all have to go live there. I mean, are you talking about having a legitimate residency and actually spending all your time in the UK? Or are you talking about a paper
If
residency?
I was like that horse player who was inevitably going to hit the $1 million, or was it the slot player, whatever, then hey, London is one of my favorite cities in the world. I could easily see living in the UK.
All right.
Bob is flabbergasted. His jaw dropped. I could do the show remotely, Bob.
Then I'm relieved. I want to continue doing this show, and I want you to continue doing it with me. So I'm happy. So let's read a happy question. If you win more money gambling at, say, poker, than your annual salary, Can you deduct losses and other write-offs?
Well, anyone who gambles can take gambling losses up to the amount of their winnings. That's Section 165D of the tax code. Gambling losses for an amateur gambler are an itemized deduction, so you'd have to itemize, but the ability to take them exists for everyone. However, only professional gamblers can take necessary and ordinary business expenses. So you have to be doing it on a regular basis for your livelihood, which doesn't matter. It's not, whether you win $1 million and your day job pays you 100,000, or you win $1 and your day job pays you 100,000. It's based on time, effort, and intent.
Wait, now I'm confused because I thought earlier we said, or you said, that non-professional gamblers could not write their gambling losses off against their wins.
No,
They can?
yes, any gambler can take gambling losses up to the amount of their wins. Now, they're not netted together. They go on two different lines of the tax return. Gambling winnings for an amateur gambler are other income. They go on Schedule 1. Gambling losses are an itemized deduction, and they're allowed up to the amount of your winnings. What I said earlier was an amateur gambler cannot take business expenses.
Okay.
All right, next question. I just quit my job and plan to file as a professional gambler next year. Since I'm going full-time into professional gambling with 5 months left in the year, can I file as a professional for only my winnings that come after my full-time date? Or will I have to pay self-employment taxes on all my 2022 winnings?
You'd only owe self-employment tax on the income during the time you were a professional gambler. So if you were an amateur gambler for the first half of the year, you would not owe self-employment tax on any income earned during that portion of the year. You also, though, during that portion of the year, can't net your gambling wins and losses, and you don't get any business expenses.
Okay, next question. Do you set up S-corps for any of your pro gambler clients? If no, why not? And if yes, what are the benefits?
Well, I don't set up business entities, period. Again, that's the province for an attorney. So anyone who wants to form a business entity, and these days, most business entities are LLCs, and LLC can make the election to be an S-corp. You need to talk with an attorney in your jurisdiction. Some jurisdictions do not allow, for example, LLCs for certain professions. LLC law is not uniform among the states. As far as an S-corp for a professional gambler, first, the savings for an S-corp relates to self-employment tax. A professional gambler owes self-employment tax on his or her net income. Self-employment tax is based on 92.35% of the net income of a business at a rate of 15.3% on the first $147,000 of net income, 2.9% above that. Those are 2022 numbers. The Social Security base wage adjusts every year. S corporation owners do not pay self-employment tax. However, an S corporation owner who owns 2% or more of the corporation and who is active in the corporation must be paid a reasonable salary. Let's say a professional gambler forms an S corp and he makes $150,000 in that year, net of expenses. Let's assume a reasonable salary is $100,000. The savings from an S corp would be nearly $6,000. Do note there are costs. A second tax return. The S corp has to file its own return. Possible state issues. California, for example, charges every business entity $800 a year. Costs of payroll. Payroll cannot be back-ended. There is a tax court case directly on point. You've got to pay yourself a reasonable salary at least monthly. Their employer-only payroll taxes. You have a cost of a payroll service and state charges for forming the business entity. As to whether or not a professional gambler can have an S-corp, I participated in an audit, was not my client as far as return preparation, but this individual had an S-corp for gambling. The IRS's position in this audit was that the proper reasonable salary for a professional gambler was 100% of the net income. That basically means an S-corp would not make sense. Now, that's the IRS position in the audit. That is not a court's position. There have been no cases on point. One of the tools that we use as far as figuring out reasonable compensation is a service called RC Reports. That stands for reasonable compensation. You plug in, your geographic area, what you do, and some other information, and it spits out, well, a reasonable salary for this profession is 80,000. It basically doesn't work for professional gamblers. Part of it is if we think about a professional gambler, everything is basically his salary. If you think about it, it's all earned income, it's all related on your performance. So I understand why the IRS had this position. I don't think a court would agree with the IRS's view. The problem is, do you really want to be the test case? In that audit, the IRS really wanted a test case to come out. They wanted, because there are now quite a few of these S corporations for gamblers, they wanted to have a case go to tax court. Now, even though that was what the IRS wanted, when you have an an audit, and you lose, one of the things you can do is go to IRS appeals. And you have 100% right always to do that. And appeals wants to settle. Even though the IRS auditor didn't want to settle, appeals wants settlements. Appeals could look at this and say, the 100,000 you were paying yourself, that's reasonable. And mind you, the individual involved here was paying himself a salary that I thought was reasonable. This particular audit, by the way, the IRS allowed basically the individual to not adjust his return if he agreed to close his S-corp. Since his wife said you are closing the S-corp, it was a win for everyone.
Okay, let's do another question. What most frequently overlooked tax deductions or tax avoidance methods for professional gamblers?
The specific deduction is probably the home office deduction. A lot of people are scared to take it because back in the early 2000s, it was a very high audit risk deduction. The IRS lost a string of tax court cases in the mid 2000s where the tax court basically said to the IRS, what in the world are you doing? These people are working from home. They have a legitimate home office. Stop this. And the IRS generally has. In this day and age where a lot of people are, the gig economy, a lot of people are working from home. Related to this, though, you need to keep paperwork and logs. There's a line in one of Tom Clancy's books that if you don't write it down, it never happened. If you keep good records, tax is not that difficult.
All right. Next question. If your CPA with more than 25 years of experience in accounting, mostly with casino/lottery players, not sports bettor, strongly advises you that you can write off a substantial amount of your sports betting profits and or not report your earnings because they are still being held in your sportsbook account, or you weren't sent any tax information from sportsbooks, should you find a new CPA? Is the individual ultimately still responsible even though the CPA is the expert?
Well, the first thing you probably should do is let the CPA direct him to a continuing education course on what is called constructive receipt. This is settled tax law, and I'll be blunt. Assuming the winnings are not held, if you have full access to that account and you can withdraw it all, that's income, period. That argument has a 0%, the argument that the CPA says has a 0% chance of being upheld. That is settled tax law. Second, you, the taxpayer, are always responsible for what's on a tax return. If you have knowledge that something is wrong on your tax return, you'll be held by the IRS and courts to be liable for tax, penalties, and interest. In fact, courts have held that you can be held responsible for penalties on omission of items on the tax return, even when you gave the paperwork to your tax professional. You absolutely should and must review your tax returns.
Next question. How should taxes be handled with using beard accounts at legal domestic sports books? I'm going to need to start using relatives to make accounts to bet into, and I'm happy to pay taxes on my earnings, but I want to make sure the relatives are in the clear themselves.
Just like some other scenarios we went over earlier, the relatives will need to send that individual 1099s for his income. Do be aware that these beard accounts may, and I would think probably, violate the sports book's terms and conditions. That's a legal issue. I'm not an attorney.
So the the beard, let's say they have $10,000 in income, they get 10,000 income, they give their friend, relative $10,000 and a 1099 saying, I gave 10,000 to him. And so they have 10,000 in income, but a 10,000 write off on their return.
Correct. It's called nominee in the world of tax. Every so often we see this, for example, with interest income. Sometimes banks forget to change the account holder's name. For example, a minor child, an account held by a parent that automatically transfers when the child achieves majority. And we have to issue a 1099 from the parent to the child, because it's the child's income, based on what is called nominee. And this is what it is. A nominee is somebody whose name earns the income, but the income was really earned by somebody else. And that's exactly what's being described here.
Okay, Bob, I'm going to throw in a question here that was not on the list because it just occurred to me. Okay, so every year I get a 1099 from a business that I'm involved in. So I found out this year that my wife has 39 units toward her Social Security, and you need 40. So she needs one more year of having some income, and not a lot, actually, very little. So my question is, can I have my 1099 made out to her this year rather than me, and we file jointly? So the tax is going to be completely the same.
Well, first of all, Social Security is only based on earned income. That's wages and self-employment income. It's not based on investment income.
No,
So
but
it's
the
unlikely.
1099 I get is not from an investment. It's from wages and earned income.
Okay. In that situation, still no, because you'd be lying on your tax return. It's your self-employment tax, not hers. I could never, condone such a thing as a
Okay.
licensed tax professional.
Okay. Thank you. That answers my question. I'm just going to have to boot her out and she has to get a job.
Well, Richard, you could hire her to work for you, pay the appropriate taxes, and
Is
give
that
her a
true? Can I
salary for a
hire my
year.
wife to work for me?
If she does legitimate work, absolutely.
Okay.
So I was able to save Nelia from being kicked out. I feel that's a good bit of work for me doing today. So we're going to end these questions. We still have quite a few on our list. So Russ Fox is going to have to come back. I do know that mid-October is a big due date for him, so it's very likely not going to be before that. But hopefully it'll be before the end of the year. If you have additional tax questions, send them to us at gamblingwithanedge@gmail.com. Richard has a Twitter account, and many of you know emails for either Richard and or me. So, Russell Fox, this has been fun and educational, as always, with you.
Well, thanks. Enjoyed being here.
And your email, I presume, is still rcfox@claytontax.com. I'm not looking at it. I'm remembering it. Is that right?
That's right.
Perfect. It'll be in the show notes. Anybody wants to get in touch with him. All right. At the end of our show, we have a recommended section. So, Richard, do you have anything to recommend to our audience today?
Yeah, I'm what I'm reading right now, a book called Blood and Treasure, which is a biography of Daniel Boone, and I'm enjoying it. And so, yeah, that's what I've been reading this week.
So, is it any different than the Fess Parker TV shows from way back when?
Yeah, considerably different. So
Uh huh.
I kind of like American history anyway. So yeah.
Very good. My book recommendation is a novel, Something Missing. It's by a man called Matthew Dix. Dix is a superb storyteller. He's won more than 60 competitions at the Moth, along with other competitions. He's been on this show where he told a story about competing against Vietnamese arm wrestlers. The stories he tells now have all been true, and he's part of the story. Something Missing was his first novel. He's written a couple since then, and he's not a character at all. The hero, Martin, has a career of stealing things from the same people over and over again. Martin calls them clients. He's definitely OCD, and he makes it follow strategies with AP-like precision, which leads to his success. Like Josh Axelrod said in his book, he can repeat this until rich. Of course, things go wrong and everything changes, but otherwise it wouldn't be an interesting novel at all. I'll leave it to you to find out what goes wrong when you read it. You'll be glad you did. Russell Fox, do you have our recommended for our listeners?
Yes, I am going to recommend a book in my subject area, nonfiction book, probably the best book on the history of tax. It's a book called For Good and Evil: The Impact of Taxes on the Course of Civilization by Charles Adams. If you're at all interested in the history of taxation, which is a long history and has impacted both positively and negatively the world, it's an excellent book. It's not a difficult read. It's not, how do you compute your taxes? It's not the tax code. It's much more interesting than you might imagine.
Huh. So does this go back into like ancient history of taxes? Or is this just taxes in America or what?
It goes back quite far.
Huh.
I do think it's a low standard to be more interesting than I think it would be. Uh, but but who knows? It might be interesting. All right. Thank you, Russell. Thank you, Richard. Go out and hit lots of royal flushes, everybody. Good day.